Well, welcome back to another episode of the Wise Wealth podcast with myself, Josh, and Shaun. I think we have a really good episode today. The title for our episode is When the Market Drops. We're looking back at history and then using history to determine what's the best move looking forward. So I'm just going to go through a couple of different points that we're going to hit off today. Shaun's going to introduce a couple of things, has a couple of thoughts to kind of set the scene. And then we're going to jump into some history, look at past market downturns. I have a pretty cool study, I think, that on investor behavior during downturns, specifically the COVID-19 crisis. We have some really interesting charts from Dimensional and Canada Life. And then at the end, you're going to want to stick around. Shaun's going to go through some really practical solutions and strategies to weather downturns and market storms like the one we're seeing right now. So without further ado, Shaun, do you want to jump into kind of your opening thoughts?
Yeah, first I want to acknowledge that for many investors, this is a really challenging time right now. So there's been lots of volatility in the markets, with the markets trying to digest the Trump tariff strategy, and sometimes it feels a little bit incoherent, but nonetheless, it's been a very frustrating time. So I want to acknowledge that. We do not want to come across here as being dismissive of the volatility. At the same time, we're going to cover off some sort of perspective information. I think that's important. Josh has got some great content. And at the end, like Josh said, we're going to cover off some specific strategies that we need to be mindful of. So the first thing is just a little bit of perspective. If you look at the S&P 500, its year-over-year return is minus 1.43%. So obviously the market had been doing a lot better, but in the grand scheme of things, we had a really good 5-year run. So if you go back and look at the S&P 500 from where it was back 5 years ago to where it is today, even though we've seen this most recent drop, it's been a pretty good run in the market. Now, for those of you that have been investing recently and all of a sudden you've put some money in the market, obviously it's a lot more frustrating. But for many of you watching this video, you probably have been investing for a while. And so you've had some great momentum as well. I know for a lot of our clients, we've been profit taking along the way, which is always an important discipline to do, particularly if you're retired. And we need to remind ourselves that, volatility is a feature of the market. It's not a bug. It's just part of what the markets do. I've got a chart here that will be up on the screen for you. It just looks at the market cycles are a fact of life. And we can remind ourselves that, the tech wreck back in the early 2000s really had a big impact on the market. We had the financial crisis in 2008. Again, another very dramatic time in the market. We also had the COVID market correction. Didn't last long, but it was pretty dramatic. And now we're going through another period of market volatility. And we'll look over some information that we hope will be a bit of an encouragement to you, because what goes down does come up. And some of the strategies we'll talk about will help you to take advantage of the volatility that is in the market. So that's kind of a few introductory comments.
Yeah, so I think we can talk a little bit about this study I found. So when we were preparing for this podcast, I wanted to see if there was any literature out there that dove into investor behavior when large market downturns occurred, and maybe we could learn a couple things from that. So I found this one. This is out of Hiroshima University. So the title of the paper, Unraveling Investor Behavior, the Role of Hyperbolic Discounting, which is just present bias in investors. That's what hyperbolic discounting basically means. So the role of hyperbolic discounting in panic selling behavior on the global COVID-19 financial crisis. So it was a recent study out of Hiroshima University. They had originally about 180,000 participants in this study, a really large study. Because of unfinished questionnaires, the data set became 120,000, so they lost a bit of a chunk there. It aimed to understand why investors panic sell during market downturns and why others remained invested. And they found that a large driver of why people panic sold was hyperbolic discounting, or a bias to want something in the present. So specifically, hyperbolic discounting is a cognitive bias where people choose smaller, immediate rewards over longer term, larger rewards. Yeah. So the important distinction there is it's a smaller immediate reward, right? And so they found other contributing factors like risk aversion, and the risk aversion is distinct from present bias in the study. Low financial literacy, lower income, and overconfidence are all factors that play into this. What they basically found were 1%, just over 1% of investors sold all their holdings during the crisis. Almost 5% sold some or all, and of those who panic sold, they were disproportionately likely to exhibit hyperbolic discounting or present bias. Demographically, men were more likely to panic sell. People with lower education levels were more likely to panic sell than people with higher education. Older investors were less likely to panic sell. And I mentioned this earlier, but they made a distinction between hyperbolic discounting and risk aversion. And risk aversion, they define it as a stable personality trait or preference of people who just don't like uncertainty. So they want to avoid risk. And it was a stable trait. But hyperbolic discounting, they found, was more impulsive, and it would pop up in these times of uncertainty. So it was this present biased decision-making style that they saw during these market downturns. So I thought that was kind of interesting. When you look at a large group like that, I would have thought it'd be a higher percentage that made big portfolio changes, like 1% selling all and about 5% selling some. I honestly would have thought it'd be higher than that. But Shaun, any follow-up thoughts based on that?
Yeah, like I think some interesting points around the data related to the social, psychological, and educational components to the study. And so I think that we often say to clients, you need to always remind yourself you're a human being, you're not a computer, you're not a robot. And so when we put into place well thought out strategies for our portfolios, an element at some point is going to come into play. And whether it's a market decline, whether it's a life event that happens that creates stress in your life, those emotional periods can set you up for making bad decisions. So the more stress we're under, the more narrow our thinking and the more reactive, like you said, we tend to be. As well as we get older, we tend to be more risk adverse for obvious reasons. The challenge is when we do work for clients, often they do need some equity exposure in their portfolio. And so that's a hard thing to sort of reconcile. We want to become more conservative, yet we may need some growth assets, high quality stocks in our portfolio to achieve our goals. And then the education piece is important. We always say to our clients, we don't expect you to become an expert in the investment area, but there are some basic principles that we do hope and expect that you'll sort of understand, embrace, because it'll make you a better investor. And the more you delegate and don't take ownership, don't educate yourselves a little bit in the way markets work, the more you set yourself up for a potential problem when there's surprises in the markets. You will capitulate. So you add in the things like age, getting older, stress, anxiety, and the fact that some people don't have a lot of education in the area or very limited, at least to bad decisions. And I think we always have to remind ourselves that there's other aspects going on all the time. So again, human nature is such that we'll have a herd following bias. We're going to follow all the other crowds in a certain direction because that's just a natural tendency we have as human beings. But where the crowd goes is not necessarily the right direction that you need to take, particularly when it comes to investing. The other thing with investing is when the markets aren't doing well, we have a compulsion to fix the problem. Whereas often doing nothing, believe it or not, is the right solution, particularly when you go through a bear market or doing something like adding back to your portfolio. So not your portfolio is badly constructed. Your advisor probably has done a good job. Maybe you've bought yourself some great quality securities, but you are not inclined to buy, which you probably should in a bear market cycle for sure. And then you've got issues around how we weigh emotionally financial decisions. So one unit of loss, to equate to that from a positive standpoint, you need 2 to 3 units of gain. So because we weigh a loss far more than gain, we tend to overweight volatility in capital markets. So if you look at the markets today, like I said, we've had a great 5-year run. I'm not discounting what's going on right now. It's very disconcerting. But the reality is, overall, the markets have done well over the last few years. And so you'd think we would remember that, but we won't as human beings. We're going to focus on the short-term volatility and the anxiety and fear of loss that's going on right now. So those things sort of jive with some of the things found in that study.
Yeah, I think that leads us into the next section of this. We're going to pull up a chart here from Dimensional. So what you should be seeing on your screen now is Dimensional's chart here. So do downturns lead to down years? It's a year-by-year return. They show from 2004 to 2023, and they're using the Russell 3000 index for their numbers here. So in the blue, you have the positive calendar year return. The red is the largest intra-year decline, and then the greenish yellow is the negative full calendar year return. So in those years, the annual return was negative. And I'll just read the little blurb they have on the side here, on the right side here. So, stock market declines over a few days or months may lead investors to anticipate a down year. But the US stock market has had positive annual returns in many years despite notable dips. So intra-year declines for the index ranged from 3% to 49%. Many years had large declines, but they still saw positive annual returns. And in the last 20 years, 17 have ended up with positive gains for the year. So yeah, I just thought this chart would be good to kind of look back and just remember, like, there have been many years with relatively large dips during the year, and they ended up with positive annual returns. So Shaun, is there anything that jumps out at you there?
Well, the thing that jumps out at me, and I hope it jumps out at most people looking at the chart, is every single year there's an intra-year loss. So there is psychologically this thing where I think a lot of people feel that, you know, markets, do poorly. There's a bear market cycle. Then, the news becomes a little bit better. It gathers momentum. And all of a sudden we're now in, growth territory. And that's just not the way it works. There's a loss every single year here. And if you're trying to read the economic tea leaves or the news about when to be in, when to be out, it's impossible. In fact, there's another chart we sometimes put up when we've talked about that, is that if you look at the last number of years, the daily volatility is significant. And in fact, some of the best days and worst days are stacked up right against each other. And what that means is that it's impossible to market time. A lot of us are attracted to, whether it's Squawk Box, BNN, Bloomberg News, and there's all this information. We talked about this in a previous video where there's prognostications, but the reality is nobody knows for sure what the future is going to hold. So this volatility is just, part of what our experience is going to be as investors, and you can't time the market. So it brings up, a quick comment that about when you talk about process or, process for investing and recommendations, how to handle these markets. But the first thing that you need to really get your head wrapped around is, like, why do we buy equities in the first place? If we're going through all this volatility and now there's all this crazy news that's going on and creating anxiety, why do we put equities in a portfolio? And you probably know the answer to that question, but I'll just kind of go over it with you. It's because when you looked at your overall investment mix and you looked at your plans, at some level, you probably thought that you needed to get the return potential from the stock market in order to achieve your long-term goals and objectives. So for most people, I know for our clients, the reason they have high quality equities in their portfolio, it's not because they're signing up because they want more volatility. Yes, the market's up about 75% of the time and down 25%. But every single year, as this chart shows, it's down. So why do we sign up for this volatility? Because we believe that over the longer term, we'll get better long-term growth to help us achieve our financial goals, particularly for retirees' retirement income. So we'll talk about ways of defending against that volatility, but it's just part of what comes with the territory of equity investing. I don't want to dismiss that volatility, but we do it intentionally because we're hoping that over time we'll drive better performance from the portfolio.
Yeah. And just thinking about portfolios in general, what are you getting compensated for as an investor, right? It's risk, right? And one of the main risks is volatility. And so it should be expected you're not going to get any return with no risk. I think that the fact that there are so many intra-year declines, almost pretty much every year, some to 20%, 12%, negative 11%, I think just really speaks to that.
Yeah, there's another chart that will be up on the screen, and it's called Markets Are Up More Than They're Down. It sort of just transitions into the comments I just made. But if you look at the chart on average, it's from 1950 through to 2022, and you can see the green is all the bull market cycles, and the brown there is the bear markets. And you find that the average bull market was up 105%, and the average bear market was down 29%. So clearly, the average bull is higher and way longer in terms of duration than the average bear on average. So we show you these charts not to dismiss the market volatility, but try to give you a perspective, because there's so much anxiety right now, and the news media is just having a wonderful heyday with this, right? They get clicks and viewership by creating anxiety for us. But why would we believe that this time it's actually different? Why would we believe that it's now the game's changed? So these charts are really helpful to kind of help us step back and go, okay, Yeah, probably going to see a pullback with some of the short-term volatility and uncertainty on tariffs, but eventually we're likely to see a reconstitution of value over time.
Yeah, that chart's really cool.
So, Josh, maybe sure you came up with an interesting quote the other day that I thought might be helpful to this discussion.
Well, I wish I could take credit that I came up with it, but I found this quote online from a guy named Tom Gaynor, and
Mhm.
I mentioned this before. I don't actually know much about him, but it was a really good quote. And the quote is, "In a bull market, your time horizon grows longer and longer, and in a bear market, your time horizon grows shorter and shorter." And so I think it's really pertinent to the conversation we're having right now, where we have to put everything in the perspective of our time horizon, right? If we're planning for the long term, then there are certain things that go with that, right? If we're mostly in equities, we're going to experience short term volatility, and in bull markets, investors feel really confident because we're getting good returns. Now we're thinking like, oh, what if I keep up this 10% for 20 years? Where's my money then, right? And then all of a sudden there's a bear market, fear kicks in, and we start thinking in days or weeks, what am I going to do? And so we start looking for immediate relief, like selling out of the market. And referencing back to hyperbolic discounting or present bias, we'll give up a larger future return for a smaller present comfort of selling, getting out of the market. Maybe we're giving up some money down the road, but it makes us emotionally feel better. So I just thought, yeah, the quote was really interesting. So moving on, I think this is the last section we're going to cover off here, but it's a really important section. Shaun, you wanted to talk about some really practical strategies that maybe the viewers watching could implement themselves, or they could bring up to their advisor, or they could come talk to us about. Do you
Yeah.
want to take it away from here?
Yeah, absolutely. So these strategies never get old. We've been doing this kind of work for 30 years. I made the comment we've never had a client unretire. The reason for that is that all those strategies they're fairly simple and straightforward. What we often find is that people do not execute on all these strategies on a consistent basis. They kind of shoot from the hip or they don't have effective planning. So let's kind of go through some of the key things to think about. Now, at the beginning of this podcast, I talked about, first of all, do you need equities? That's the very first question you need to answer. Why would I put money in the stock market when it goes through volatility when I could just put my money in GICs, savings accounts, or under my mattress? And that first answer is because you likely need additional returns. You're hoping that the stock market's going to deliver to you some additional returns through dividends and price appreciation, and for your non-registered portfolio or your corporate account, some tax advantages as well. Okay, so that's the first thing. Now, how did you arrive at that decision, right? So when you do your financial planning, it's always important not to take on more financial risk than is necessary to achieve your goals. So you arrived at the idea that you needed some equity investments, either because you did the planning or you hired someone to do it with you. You came to the conclusion that some allocation to stocks or stock ETFs, as an example, would be appropriate for you. Okay, so you need equities because you've done some planning. Now that's being introduced into your portfolio. Now, the next piece is hopefully some financial education has gone into that. Your advisors talked about how equities perform. The biggest risk is a short-term risk. The longer term, your equities experience basically reversion to the mean. The expected returns come more and more in line the longer you hold on to the asset. So one of the ironic things with equity investing is it becomes less risky the longer the time frame. So, but part of that is this idea of diversification. For most of our clients, yes, this is unnerving, this period, but they have money in cash, they have money in bonds, they have money in real estate, and they have money in stocks. They don't have all of their assets tied to the stock market, which is in the news every single day. And they have broad diversification between those different asset classes. And then once they've built a portfolio with that broad diversification and they have a plan that gives them direction, that confirms they need equities, what they are doing is systematic rebalancing. And that is a really practical strategy that gets introduced because of human nature. We do not see clients running into our offices dropping big checks down right now. But we'd argue that this is actually a great time to rebalance. And so having some securities that systematically rebalanced so that it's just automatic through these dips is a really important part of the strategy. And so the last piece would be have a cash wedge. So when your plan is in place and you need money or liquidity in the short term, let's say you need money in the next 3 or 4 years from your portfolio, you want to build in a cash wedge, non-market investments that are set aside in GICs, high yield savings accounts that are there at the ready that you can access either for income, but particularly when markets aren't doing very well. So for some of you that have not done any of those steps, this is unnerving. You probably do want to look seriously. Do I have a backdoor strategy? Do I have a line of credit? Hopefully you've got some savings so you can allow your portfolio to reconstitute itself on the stock side. And for those of you that are doing planning, your steps really are those. Let's just summarize them very quickly. Number one, do you have a plan? That plan is going to help you confirm whether you need equities. You need to have broad diversification. Get exposure to the market through broad-based ETFs. Make sure there's systematic rebalancing in your portfolio. Make sure you've got a cash wedge, a line of credit, and some budget flexibility to deal with uncertainty in capital markets. And if you do those things, you're going to navigate these periods successfully.
Yeah, that's really good. So for some people listening, they might be a little bit uncertain on how to execute or even create a plan. If someone is watching and they're like, how would I get a plan? Where could they go to talk to someone to get that looked at?
Yeah, if you go to the show notes for this podcast, there's links back to our website. And at the website, you can find out more information about our retirement planning services. As well, there's some free retirement planning resources you can download. And you can set up a complimentary 30-minute meeting. We'd be happy to connect with you. You can find out more about our services and how, confidence and peace of mind is one of the natural outcomes of having a solid plan done by a professional company that's what they do. We do retirement income planning. So it's just a great peace of mind exercise and becomes even more of a peace of mind exercise through times of uncertainty that like we're going through right now.
And retirement planning isn't just for people who are a couple of years out from retirement.
Yeah.
The plan can be even more effective when you start planning 20, 25, 30 years away from retirement. So if you're in your 20s and you're like, why do I care about retirement income planning when I'm so far away from retirement? Well, this is even better. You can get even more out of a good plan when you're that far away from retirement. So for sure, go to our website and book a 30-minute complimentary call, and we'd love to connect. I think that's it. We've covered off pretty much everything. A little bit of a shorter episode today, but I think it's also relevant to the times we are in. So if you made it this far in the video, thank you for watching. Hopefully you got some benefit from that, learned a little bit here and there, and we will catch you in the next episode. Take care.